Our next guest says the second half of this year is when Tesla's hyper-growth narrative falls apart, and next year, access to capital markets wanes. Joining us now is Gordon Johnson, CEO and founder of GLJ Research. So we want to hear your entire bear case, Gordon, and how many years have you watched as this has just sort of confounded people with your view? And have you been recommending a short the entire time?
Yeah, so we have been recommending a short the entire time. And, quite frankly, it really kind of took off late last year. So let me just go through the thesis very quickly.
Okay.
So if you look at Tesla, right, what's key is revenue. I don't think it's production or shipments, because at a certain price, there's infinite demand. At $1, everybody would buy a Tesla car. So if you look at their revenue in the fourth quarter of 18, essentially their revenue has peaked in the fourth quarter of 18. And if you look at 2Q estimates, you're not going to see revenues at that level for the past 6 quarters. So when you think about this being a hyper-growth story, the numbers just don't pan out. If you go on and you look at their market share, Netherlands, Norway, Spain, and the reason why we cite those is because they provide registrations daily. Tesla's market share in those 3 countries combined has fallen from 35% in the fourth quarter of last year to 3% 2Q quarter to date as of last Thursday. And specifically Norway, which is the most advantageous market for EVs, they basically subsidize 50% of the EV. Tesla's market share has fallen from roughly 37% in 1Q of 19 to roughly 4% 2Q quarter to date through today. And the reason why Norway is important is because if you're thinking the world is going EVs, that's the market to look at. That's where you have all the competition. And keep in mind, Tesla's market share in Europe is literally collapsing, despite the fact you don't have the small, fully EV crossovers from BMW, Volvo with the Polestar, Mercedes, VW that are coming out later this year. And then if you look at 1Q, where they reported a small profit of 16 million, 354 million of that were regulatory credits that effectively sunset either at the end of this year or best case for Tesla, middle of next year. So that would mean they would report a loss. And if you look at their warranty accounting, where we have the receipts we sent to your producers where they're accounting for some of that as goodwill, that's another 200 million in additional profit that we don't think the company should be making. Taking a full step back, since 2010, Tesla every year has lost money looking at GAAP net income, aggregated loss of 6.7 billion. So there's no doubt we've been wrong on the stock. But if you look at the fundamentals, it doesn't look good. And we think that's going to come to the forefront as numbers come out later this year.